Welcome back everyone to day 23 of our trading podcast journey. Today we are going to talk about the trading life cycle, the entire process of planning, executing and reviewing a trade. You have likely heard about specific aspects of trading like researching a stock or managing risk, but today we are focusing on how each of these steps fits into a larger cycle. Understanding this cycle can help you approach trading more strategically, improving both your outcomes and your confidence. In this episode, we will go through each phase of a trade's life cycle and discuss how each step helps you become a more disciplined and informed trader. So let's get started. Let's start with the first phase, pre-trade research and analysis. Before jumping into any trade, a thorough analysis is key to making informed decisions. Here's what this phase typically involves. Identifying potential assets. You need to decide which assets are worth trading based on your strategy. This could mean screening stocks based on indicators, looking at industry trends, or focusing on specific types of assets that fits your trading style. Analyzing market conditions. Understanding broader market conditions like interest rates, economic data, or geopolitical events can provide context. For example, if there is an increased volatility, you might adjust your approach to manage risk accordingly. Creating a trade hypothesis. Based on your research, develop a clear hypothesis for your trade. For instance, you might decide to buy a stock if it reaches a certain support level or take a short position if there is a bearish trend. This helps clarify the why behind the trade, keeping you focused and purposeful. After research, the next phase is all about planning the trade. This phase is where you lay down specific criteria and ensure that you have a well thought out plan in place. Setting entry and exit points. Plan exactly where you will enter and exit the trade. This includes not only the price at which you will buy or sell, but also what will prompt you to make that decision. By setting clear entry and exit points, you prevent emotional decision making once the trade is active. Defining stop losses and profit targets. A well-placed stop loss and profit targets are essential for risk management. The stop loss limits the potential losses, while the profit target helps lock in gains. Position sizing. Decide how much of your capital to allocate to this particular trade. This is where risk management comes in. Never risk more than you can afford to lose. Position sizing can help you minimize risk by ensuring that even if the trade doesn't go as planned, your losses are manageable. With a solid plan in place, it's time to execute the trade. This phase might seem straightforward, but it can actually be one of the most challenging parts of the trading life cycle. Monitoring entry timing. Even though you have planned an entry point, market conditions might change just before you are ready to enter. Watch the market closely and make sure that the conditions still align with your trade hypothesis. Executing with discipline. Sticking to your entry and exit plan without letting emotions interfere is essential. Discipline is the difference between an impulsive trade and a strategic one. If the market deviates from your hypothesis, it's okay to adjust or even abandon the trade rather than forcing it. Staying calm under pressure. Trades can actually move against you, and how you can react can significantly impact your results. Keep emotions in check, follow your plan, and stay calm even when the market fluctuates unexpectedly. Once the trade is active, the next phase involves monitoring and adjusting as needed. This phase is crucial for staying responsive to market shifts while staying grounded in your strategy. Watching the key indicators. Keep an eye on any indicators or price movements relevant to your trade. For example, If you are trading based on moving averages or volume changes, stay attentive to these indicators and ensure they align with your trade plan. Making minor adjustments. Sometimes slight adjustments are necessary, like tightening a stop loss if the market moves favorably. Avoid emotional decisions. Once in a trade, the market's fluctuations can trigger emotions. To avoid impulsive decisions, remind yourself of your initial plan and trust the process you have set up. Finally, once you have exited the trade, it's time for the post-trade review. This phase is all about learning from the trade, whether it was a win or a loss. Reviewing the trade outcomes. Look at the results of the trade. Did it hit your profit target, or did you exit at a stop loss? Assessing your decisions. Review the decisions you made at each stage. Did you stick to your plan? Were there any moments where emotions influenced you? Documenting key takeaways. Note down any lessons learned and consider adding them to your trading journal. And that's a wrap up for day 23. So today we have explored the trading life cycle from pre-trade research to a post-trade review. Each phase plays a vital role in making your trading more structured and helping you make informed strategic decisions. By embracing each phase, you are giving yourself the best chance at becoming a disciplined and successful trader. Tomorrow we will cover an equally important topic, that is adapting to the different market conditions. Markets are dynamic, and understanding how to adjust your approach can be a game changer. Be sure to join it. Thank you for listening, and I'll see you back here tomorrow for day 24. Thank you everyone.